Okay, guys. Well, welcome to Round of Wealth annual client investor presentation. This is our fourth one since 4 years ago. We were granted the Australian Financial Services License. We we look at this as we look at having the seminar as a bit of a requirement from a regulatory perspective. We see that more than just a tick and flick. So with each year, we've always invited some key speakers to to share with us their insights that would hopefully be valuable to attendees and also giving us some real key points about what they're seeing in their field of expertise. We have assembled a good panel today in terms of very experienced financial services and investment managers. So I think, if anything at all, those that haven't attended will get the recorded version and his stuff. And but it will be some key nuggets there for takeaways to apply in your personal investment outlook, but also incorporating your portfolios as we move forward. Um, just in terms of Round of Wealth Advisory, today's presentation, it goes without saying, there's, if you can see that, there's a disclaimer to say today is about general information, and and to consider your personal circumstance before acting on any of the information. And hopefully, the advisor and myself, or in our network, or your advisors can actually counsel you before acting on those. Just some housekeeping rules, just everyone to mute. I've tried to set up a webinar, but today is really more of a Zoom meeting because I felt that if we can make it as interactive along the way, that'd be great. And we'll have some Q&A at the end. If you have any questions, it'd be great. So in terms of our speakers, I'll introduce them individually. One could not make it today. So we've got Scott Garner as his representative from Zenith Partners. I'll introduce him, and Damien, who could not make it, but was kind enough to record his economic update and market summary and insights, which I'll share with you as well. And I guess a little bit about Round of Wealth Advisory. We were licensed directly with the regulator in 2020. If everyone recall 2020, there was some would say the magic year, but it was COVID impacted, and everyone was running every which way in terms of organisations and individuals, and obviously we were subject to various things that was quite adverse to people meeting each other, and that suited us quite well because we were in the view of trying to make advice as accessible to our clients, our existing clients, but others that are time poor during the day and can't really, pack up, run to a meeting, and leave their work during the course of business days and business hours. So it was quite conducive to our outlook on trying to provide quality, compliant, and cost-effective financial advice. So from that perspective, it all did well. But it was also coming with having an Australian Financial Services license was a reasonably high level of responsibilities and commitment. But it has helped us align more naturally with our clients' needs, and our existing clients just see us as a personal relationship rather than a business relationship, which from the verbatims and feedback we get sits quite well with us. We endeavour to be as conflict free, so we're not held by any institutionals. We ensure that the advice we give, we put the client and some of you existing clients, our partners at the centre of everything we do, so their needs first before any kind of outcomes or benefits. We take a true, pure fee-for-service approach. We don't charge for things we don't do. We obviously understand the client's needs, identify the scope of advice, and we price it accordingly. And that will be the case forever because it's long gone are the days where we charge for work we don't do. So we're very much aligned with professional service providers, professional service providers such as accountants, lawyers, solicitors, and the rest. We try to be lean, mean, and green. So for us, if we can just be as small as we can, we could be accessible to our clients, but big enough to reach out to great partners like the three we have today from respective organisations to share some of their insights and help our clients grow in their wealth. But also, in our view, wealth is one part of overall well-being. You've got wealth and also personal, but they're intrinsically linked. So what we want to do and what we've been proud of doing is trying to provide great advice so it improves our clients and their community's well-being. We've got, I can't say that we've got here by myself. We have a great team. I founded the organisation simply to provide great advice to Aussies 4 or 5 years ago. As the advice industry, financial planners were under a lot of pressure. A lot of us left the industry. I still felt that we were in the midst of a massive intergenerational transfer. There was a lack of pure independent financial advisory firms out there. So it sat well with me to be able to just lead the way on that in a small way. And we have our operations manager who's with us today here in Ewan, who's been there from day dot. So she manages all the things, all the flows and all the requirements of the business to keep it viable, and also making sure that it's sustainable for our existing and future clients. Ryan Moore, who's going to jump on later, is from More and More Accountants. They were incredible in helping us set up the license. I've known Ryan Moore's dad for a long time, and he was able to provide a referral to help a reference, even knowing me for 10 years plus as a person, as a personal relationship, but as an ongoing business relationship, which was very hard to find at the time. But Ryan is the young man taking charge of the advisory business and constantly provides us with input. And Evelyn's our compliance consultant, so she keeps us right up to the standard required. So there's two standards in our view. There's the regulatory standard, there's the industry standard, but then there's also the rounded wealth advisory standard, and we ensure that everything we do is highly compliant. So we're no different to any advice businesses with an AFSL or Australian Financial Services license out there. We're adhered to all the requirements, plus more to ensure we're viable and compliant without any issues. So this is a little bit about inner and external advisors. They've been part and parcel of where we are and where we're going. In terms of our business, we, as an advisory business, we call it a financial service advice organisation. We focus really holistically on our clients' needs. So if you think about the three buckets or the three pillars for us, it's wealth accumulation, meaning building and growing one's wealth with a range of topics that we apply with our clients: cash flow, super, retirement planning, debt management, debt recycling is becoming quite common, redundancy, aged care, portfolio management, and that's the wealth building. And most clients prospectively seek advice to grow their wealth, to save tax, to be able to be in a better position in 5 years. But our plan doesn't, our focus on our clients do not overlook or understate the importance of wealth protection. And we're referring to contingency events. So the what ifs in family situation, protecting the main income earner or both income earners in the event that something happens to them. In a business sense, business insurance is really important. Some businesses, small, big, or in between, don't realise the exposures that they have, particularly with an ageing Australian society, that you have leading or directors of businesses that are aging and they haven't thought about succession planning and how to gradually transfer ownership of the business to naturally whoever's in the business or future successors of the business. It's a really key area, and we'll have one of the speakers, David, to speak about the intergenerational scenario that's occurring at the moment. And the third pillar is the wealth distribution. I mean, you wouldn't believe it, 2 out of 3 Aussies don't have a valid will. That is an issue because you want to have clear instructions in terms of what happens to your asset and who it goes to, the right people, the right format at the right time. And I'll always remember the first many sessions I had with an estate planning lawyer. She always mentioned that a good estate plan is one that adheres to all stakeholders and ensures to limit any contesting, which means more legal costs in the future. And the other part of that is the superannuation beneficiary nominations. A lot of people overlook that. They nominate mum or older kids. It's important to know or to note to nominate the correct valid beneficiary or beneficiaries which are different to just your kids who are older or mums and dads or relatives. So we go through a whole range of work with our clients, capturing those 3 pillars, and it's all about them in the heart of the advice. And how we measure our advice is we do a yearly review and make sure that we're basically goals oriented in terms of tracking the different goals and objectives set out in the first few discovery meetings and in the subsequent advice as well. So that covers what we're about. We want to make sure that value is far exceeding price. So most of the time, in fact, all of the time, when the client commits to our advice, they would get a range of personal clarity of where they're heading, peace of mind, and really clarity about what are the next 1 year, 3 years, 5 years, because it's important to focus on those first few 5 years for the plan to gain life, because it is a blueprint of their life and the goals they've shared and the issues that they want to avoid. It's important for them to have that clarity. So we spend a lot of time looking at that as well. For us, in our small way, the quote that I always share is 1 small step for men, 1 giant leap for mankind. And I think that's really important in terms of what we said about to do, not to be the biggest end of town, really to be focused on our clients' needs and to be able to deliver in a time-effective manner. And glad to share and introduce our guest speakers, so they will obviously share their views of their area. Got Damien Hennessy, who's not with us in person. So we've got Scott Garner from Mammoth Investment Partners, which is a leading investment research house and asset allocation provider to investment markets, financial services providers, and a whole range of stakeholders. So they live and breathe the market and positioning of assets depending on trends and insights. So Damien's been kind enough to record his session, but before I introduce him, I'll let Scott mention a few things, if that's okay. Just introduce yourself, Scott.
Yeah, thank you, Finlay. Thanks, everyone, for having me. I won't take much of your time there. I think, Finlay, you've done a better job than I could have of introducing Damien. He's really sorry he couldn't be. He had a funeral to go to that came up over the weekend. But really, I think there's 2 core elements that Finlay's touched on with us. Is we're in the business of 2 things: investment research, and so what that means is that our team of analysts will review over 1,000 managed funds and ETFs in the marketplace. We will sit down with the portfolio managers, understand how they run money themselves, and we'll come up with a rating for that particular investment option. And then the second part of our business where Damien comes in is we will take that list of 1,000 different investment structures and we will construct an investment portfolio for our clients. So clients like Morgan Stanley, rounded wealth as well will tap into this portfolio work that Damien has done. And so Damien, as I said, is our head of asset allocation. He's ex-CIO at HSBC. Again, he's really sorry he couldn't be here, but Finlay, if and when you're ready, feel free to press record. And importantly, I know there's some Q&A at the end here. Any questions, please feed them through to us and we'll get Damien to construct some answers for you. I'm sure there's questions around Biden stepping down and the like. So yeah, please feel free to send them through.
I'll note them down and send them through after the session. So without further ado, as you said there, Scott, Damien comes highly touted in the industry. I was glad to finally organise for him to come. He's responsible for providing investment strategy and asset allocation services to Zenith's clients. As I said, retail and wholesale, whole range of clients. In 2003, he co-founded Heuristic Investment Systems, which provided investment strategy and economic analysis and asset allocation research and advice to fund managers, industry funds, wealth managers, asset consultants, and financial planning groups. Previously, Damien was CEO, Chief Investment Officer with HSBC, as Scott mentioned, Asset Management Australia, where he spent 10 years overseeing investment strategy, asset allocation and managing fixed interest and currency portfolios. He has over 30 years experience in funds management, economics and finance, and holds a Bachelor of Commerce from University of Melbourne and a Master of Applied Finance from Macquarie University. So his insights today, as I'll play it, is extremely insightful in terms of what they're seeing. And let me just play that for you, so that way you get good insight. Everything else, here we go. Alrighty, welcome Damien, if not in person, but dulcet tones.
Sorry, Finlay, is there supposed to be some audio accompanying this? Unless it's not just playing.
Can you hear anything or no?
No.
Oh, okay. 1 second. Let me just try again because people can't hear it.
I'm not sure if videos played on your screen will relay the audio through to the meeting.
Yes, it is. Just have a look at the reasons for this. Just try to remove. Sorry, guys. We'll try again.
Can you hear that now?
Just.
In this session, we're going to be looking at the key themes and forecasts. First of all, the global easing cycle, we believe, has begun. The tightening cycle is now behind us. We also believe that US growth is going to slow back to a below trend pace over the course of 24 and into 2025. The disinflation regime that we saw during the course of 2023, we think has re-emerged and is likely to continue over the course of 24 and into early 25, but the progress from here is going to be a lot more difficult. In that environment, the Fed is expected to ease two to three times beginning in September. The RBA is likely to follow, albeit a little bit later, possibly very late this year, but most likely in early 2025. In that sort of environment, there is some scope for a small bond rally, but it is limited. We also feel that the US election result, or US election and the result, carries inflation and interest rate risk with it. And then we'll finish up by looking at our portfolio positions, where we'll run through the reasons why we remain overweight quality, overweight global small caps, investment grade credit, and global equities in preference to domestic equities. So let's just recap what's happened in markets over the June quarter and over the past 12 months. Focusing on the green bars first, this is annual performance in obviously equity markets. The second entry there, this is global equities ex-Australia generating above 20% returns, a very, very strong year, and we'll talk about that in a little bit more detail shortly. A-REITs down towards the bottom, you can see they had a really strong bounce this year, albeit from a very, very low base. Across other markets, you'll notice that global small caps, the first line, lagged global equities. EM also lagged developed markets, while the Australian market at the bottom of that chart, green bar, also lagged global equity performances. But pretty much everything has rallied over the past 12 months, including bonds and credit. Over the most recent quarter, you'll notice that global small caps once again underperformed, Aussie small caps and A-REITs, while global equities and emerging markets actually generated positive returns. There's been a lot of discussion around the concentration in the US market, and that can be a bit of a concern. When we look at the concentration, the chart on the left, we can see that the bottom three stocks there, Nvidia, Apple, and Microsoft, comprise 21% of the S&P 500. This is probably the most highly concentrated the US market has been since the 1960s. Of course, they also dominated returns. And you can see on the right-hand side, this is looking at the past 6 months, that Nvidia has contributed more than 10% of the overall 15% return from the S&P 500. And the other AI-related or mega cap stocks have also been key contributors, while the broad market, the other 494 stocks, actually lost ground over the first 6 months. What we can also say, though, is that this has been partly fundamentally based because those stocks and those sectors in which they reside have generated really strong earnings growth. For example, the communications sector, which includes the likes of Meta and Alphabet, EPS is around, or earnings per share growth is around 18%. If you exclude those two stocks, the growth in earnings in communications has been something like 3%. And again, in the IT sector, earnings growth of around about 16%. If we exclude Nvidia, it comes back to about 7%. So the broader US market is expected to have generated about 9% earnings growth over the year to the end of June, But if we exclude the Magnificent Seven, then that earnings number is only just turning positive after being negative for a number of quarters. So it is dominated, the market is dominated by those stocks. They are dominating the earnings picture, and they are also dominating the performance of the market. We're now coming up to earnings season, where we'll get an update as to whether these lofty expectations will actually be met. Let's just broaden this out now in terms of the macro developments over the past quarter or so. The chart on the left-hand side shows the progress on inflation over the past 12 months, where you can see across all regions, maybe with the exception of Japan, but across all the other major economies, inflation has been coming down, no more so than in the UK, which is the darkest line there, where inflation has fallen from 11% to 2%. In EU has fallen to 2.5% from close to 11%. US, as we saw recent data, slowing back to 3%. It was once 9%. Probably the interesting standout there is our own economy, Australian inflation, the yellow line or the gold line, which has seen a bit of a pickup in inflation over the most recent couple of quarters, back to 4%. So Australia's lagging that. Inflation probably peaked a little bit later here, and we're still in this period where there's some doubt as to the trajectory of inflation going forward. On the right-hand side of that table, you'll see growth. The blue line represents growth within the manufacturing sector. And you can see there's been a bit of an improvement in the last 6 months, albeit very modest at this stage, but nevertheless broadly heading in the right direction. At the same time, the green line, which represents the services sector, growth has always been above trend being 50. And so held up by the consumer, essentially, has been doing very well. But even there, we're starting to see a slowdown. The way I would read the global economy is that it's likely to muddle through at something like a trend rate, maybe slightly below. So moderating inflation and reasonable but quite modest growth. If we look now at the US in particular, and we bring up this chart of US recession watch. So we monitor whole range of different economic and market indicators that might give us some clue as to the extent of any recession risk in the US economy. The red line represents the levels of each of those series that has been associated with recession in the past. The blue line represents the last value, the last observed value for each of those variables, and the green line shows you where it was for each of those a year ago. The key point for you to take away here is we're looking for any signs that any of these indicators are within that red circle, meaning they're consistent with recession. And the only ones that really stand out for us remain yield curves, which you'll see on the right-hand side of that chart, where the green and the blue line, in fact, the most recent, are within the recession zone. And possibly the only other areas is consumer sentiment expectations and small business confidence, both of which are quite low and consistent with recession. But if you go outside that and you look at what economists will call hard data, that is, rather than survey data or financial market data, what is actually being produced, what's the actual output, most of those are well outside recession territory. To be fair, they have weakened. That is, the blue line has come in below the green line, meaning it's weaker than a year ago, but they're still well above recessionary levels. One of the areas of interest in the US is the consumer. Now, I mentioned before that the service sector has stayed pretty strong, and one of the reasons for that has been that consumers have carried excess savings from COVID and fiscal handouts over that period. But what we're now seeing is that those savings have largely been exhausted. They did top about 2.2 trillion in 2021. They're now almost exhausted, as I said before. So the US consumer now doesn't have this buffer to rely on. US elections, of course, is a key focus now. And as we've seen over the past couple of weeks, this continues. There's lots of volatility and lots of change. And in fact, we can now strike Biden off the Democrat ticket on the left-hand side. And we don't know yet who that candidate will be, and we'll find out over the coming weeks and months. Nevertheless, the contrast is probably going to be very similar. And on the left-hand side for each of those policy points in the middle, we show what a Democrat candidate is likely to bring. And we can also see what a Trump presidency would bring in respect to each of those policy areas. So domestic policy, let's just focus on the Trump. Trump is favoured at this stage to win the presidency in November. So we're going to focus mainly on some of the policies there. Reshoring, job creation, less immigration, less regulation more generally, and ESG. It's likely to favour certain sectors, potentially finance and energy sectors, or old energy sectors in particular. On the tax front, Trump is keen on extending the tax cuts and perhaps even broadening them out, whereas the Democrat side is probably more focused on ending those tax cuts as they were granted a number of years ago. With regards to tariffs, both parties have extended tariffs, particularly with respect to China. The Trump policy seems to be to broaden that out to other countries, not quite to the level imposed on China, but nevertheless to broaden out tariffs. On the fiscal side, the Trump presidency seems to be more focused on lowering tax, but possibly reducing spending in certain areas. Whereas on the Democrat side, it's probably more of a focus on increased government spending and higher corporate taxes. Monetary policy is interesting. There's some fear that a Trump presidency, if not now, then down the track, perhaps there might be pressure on the Fed's independence, and in particular, or more specifically, that Jerome Powell could be replaced. He's recently repudiated that comment. But it could well mean that there's a higher neutral cash rate in the offer based on higher or greater fiscal spending and higher inflation. On the inflation front, under a Trump presidency, we're likely to see higher inflation, partially due to tariffs and reshoring, also less immigration, which puts pressure on labour markets and reshoring. So some of these factors are also in play under the Democrat candidacy. And then geopolitics is, of course, a major area, and we've only recently seen comments coming from Trump about Taiwan getting support from the US, and also in regards to the Ukraine. So when we focus on the impact of a potential Trump victory in November, we can say tax cuts looks to be on the agenda, less regulation. It tends to boost the supply side, tends to boost growth. So it could be viewed as a positive for growth, and perhaps the market is running with that at the moment. However, we could also talk about the impact of higher tariffs, lower labour force growth, reshoring, adding to inflationary pressures. Both parties, and particularly Trump, under that new administration, budget deficits are likely to remain high, and the Fed could well be challenged over the coming 4 years. So the market impact in 2024 and 2025 is partly dependent on where the policy focus is likely to be. Is it on tax cuts and less regulation, which is positive potentially for markets, or is it going to be initially on more restrictions, less immigration, higher tariffs, which in fact could be more inflationary? Closer to home now, we want to just focus in on the RBA, and we showed the chart earlier on about inflation going forward. It's been coming down in pretty much all economies, with the exception of Australia more recently. So if we look at how markets have changed their expectations of what the RBA is likely to do, at the start of the year, the blue bar suggests that the market was pricing in about 83 basis points of easing over the course of 12 to 18 months. By July 18, the green bars, that had changed to about 42 basis points of easing happening later. And then, of course, the orange bars were showing what the most recent expectations around rates were, which was basically a 40% chance of a tightening, in fact, and less easing going forward. So expectations have continued to change over a period of time. So what does that mean for the domestic economy and indeed domestic equity market? So this is interesting. It looks at the growth inflation trade-off over the past almost 3 years, in fact. So back in June 21, we had a situation where activity was strong, that's the NAB forward orders, and inflation was low. By 2022, that had changed to activity strong, inflation high. By 2023-24, we'd moved into the top left quadrant, which was weak activity, but inflation still too high. And this is problematic because it does not allow the RBA to respond to lower growth. Until such time as that green arrow starts to turn downward and into that bottom left quadrant, the RBA is going to feel the pressure to possibly tighten, but certainly would be an impediment to easing. And that is always problematic for the equity market. And it's one of the reasons why the Australian equity market has tended to lag global markets. So where are we positioned at the moment? What sort of decisions have we been making? So I'll just highlight a few of the areas. We have added to duration, that's the second line, from an underweight position to close to neutral, still slightly underweight. As I mentioned earlier on, we're not expecting a big bond market rally or a recession at this stage. So we've lifted duration, but only back to a modest underweight position. The other change has been to, first mentioned Australia. We've gone from an overweight Australian equity position to a slightly underweight position. And at the same time, we'd increased US from an underweight to a neutral. The reasons on that Australian decision I already mentioned. Growth is lower, earnings growth is a bit weaker, and the central bank, the RBA, is not in a position to actually ease anytime soon. And then finally, just to reiterate from a style and factor point of view, we have an overweight to global small cap, an overweight to quality. They're probably the two key factor or style positions that we have in the portfolios at the present time. So just to sum up, we're positioned for soft landing, but we are very mindful of valuations starting to become extended. Disinflation will continue, although less swift than over 2023. And so our portfolios are positioned to show a preference for global over domestic equities. They have been positioned to take advantage of higher bond yields and to be overweight investment grade or higher quality credit. And we're also looking to capture the rebound in global small caps as markets rotate to cheaper sectors as interest rates come off. And we still provide a decent exposure to quality companies.
That's exceptional. That was a good session. Would you agree from Damien? Given it's as good as having him here, and I'm quite grateful for him to record that despite his personal grievances there. There's some key takeaways from that, but feel free to type in your questions. I'm happy to filter it to Scott, who was on earlier, to respond back. But probably one of the main questions I would have is with the recessionary outlook with our domestic economy, how that would impact on domestic shares, even though they're taking a position on increasing their weighting towards global equities and global small caps. But I'll take that up and then respond back to you. Any questions around the ground there that you might want to ask, and feel free to type in the Q&A. So appreciative there for Zenith Partners and Damien Hennessy and Scott for turning up on the session. Next speaker we have lined up here is, of course, David Hanson. David's from one of the fastest growing share trading platform. It came on our radar as a licensee by virtue of a few clients that have had their portfolios managed on that platform. and the efficiency you get from it, and it has a peer-to-peer outlook in trading as to which stocks are in favor amongst their clients, which ones they're looking at. So you get a real good feel, a more community feel about the trading platform, but also it has the facility to trade into international markets as well, which we found was a little bit of an advantage over other platforms that are available. Without further ado, I'll let David talk to you, but I'll introduce him as a senior BDM for Self-Wealth. Self-Wealth as in one word. They're based in Melbourne, but have exposure now with advice businesses across Australia. David has over 15 years experience in the financial services industry, specifically in servicing the advisor segment. David's talent lies in building deep relationships with clients, and he has done this in previous roles with great success for leading organisations like Macquarie Bank and Premium. So I'll let David take up if you're around, David.
Thank you. Bear with me a moment. I'm just going to share screens.
I'll let you share it. Here we go. Here you go, David.
Okay. Hopefully you can all see that.
Yep.
Okay, fantastic. So as Finlay pointed out, very grateful to always present at these sort of sessions, because this particular topic is coming up more and more, I think, as years go by, and particularly with the advice industry and some of the responsibilities around it. So I'll be talking to you about the wealth transfer and how it all works, and some practical ideas for how to sort of take advantage of it. Before I do, just make sure this works. There we go. Just a general legal disclaimer. So do your own research. None of this is personal, and now that that's out of the way, I'll just go through what I want to talk about. So what I want to go through, it's only sort of short and sweet. So we're just going to go through, what is the wealth transfer? Why is it important? Some of the sort of broader macro global trends that are playing out, and how does that sort of translate here in Australia? So some of the things that are happening here. Then just highlighting some of those key statistics that are due to occur over the coming years. And as I pointed out, so from a family unit point of view, and also from an advice point of view, what are some practical next steps that you can take advantage of to benefit from the wealth transfer? So Finlay sort of touched on some of this already, but I'll just quickly go through who we are for those who don't know. So we did in 2012. We started out as like an online community, really. So it was not even share trading. So it was just investors that would come in to a portal, and they would talk about different investment ideas and strategies. And it wasn't until 4 years later that we actually became a broker. At the time, everyone's doing it now, but at the time we were sort of famous for the flat fee, the $9.50 brokerage, which we still have. And it was at the time, it was very much to sort of mum and dad, so retail, non-advised type clients. The following year, 2017, we listed, so we became a public company, and then a couple of years on from there, we actually launched, which is when I came into the business, we launched the advisor platform. So that becomes important because Finlay and the thousands of other advisors out there need to be able to manage clients, and listed investments is where we play. So very I guess the nature is directly held, CHESS sponsored listed investments as opposed to managed funds and wrap platforms. So 2020 we introduced US trading. It's become very important, depending on different cycles, as we just heard. 2022, we launched Hong Kong trading. And I guess just overall, in terms of, so where we sit today, pretty well established as a one of the, I guess, Australia's popular trading platforms, with 10.2 billion in funds held on HIN, and about 128,000 active investors that sits across that sort of advised and non-advised space. So what is the generational transfer? You're probably hearing it pop up more and more. Why is it important? So firstly, like, I guess at its core, it's very simply just the transfer of wealth. It's going from one generation to another generation. And it's really, it's property, it's shares, it's financial wealth that's being moved. Now that's significant because it's a big sum of capital that is influencing the economy, and so the stability and the growth of the economy is influenced very much so by how this transfer is managed. So Finlay pointed out just this idea of wills, which I'll go into, but really looking at your wills and estates early on is pivotal in ensuring it's transferred in the right way. So the third point there, just around wealth inequality, there's a huge accumulation. I'll refer to the different groups as the older generation, but largely the baby boomers. So there's huge sort of inequality in terms of wealth distribution, and so that's why I guess the estate planning side of it and setting up a will, discussing it early, is very important to ensure that that's not sort of perpetuated. So, mitigating the problem somewhat and ensuring it's transferred in the right way. And that kind of, that talks to, I guess, the complexity. So if you think about the next point there, retirement and healthcare, one of the trends which we'll look at is that you're sort of living longer. And so you have to factor that in because there could be medical costs. There's longer years of being alive, and so just trying to factor that in is very important. And look, at the end of the day, it's we all have families, and so there are implications around family dynamics. When it comes to the estate planning side of things, ensuring that the emotion is taken out of it, legal matters are taken out of it, and that it's written down properly. So kind of holistically, all of these different things need to be considered and talked about at some point. And so how does that look from a global trends point of view? So the first thing to point out is that, so there's already been a significant transfer of wealth that's taken place, but it's actually increasing in magnitude. So the US alone has about 84 trillion, which they've projected. McKinsey report that came out projected 84 trillion by 2050. And so that is significant. And I guess one of the other sort of prominent things to point out is some of those economies globally. So they talk about India and China as good examples of this, but significant scale of transfer. There's a lot of private wealth held and growing within those countries because of the growth that they've had. So that will impact global economies in a big way. And I've mentioned this idea of longevity. It's not just within Australia, it's a global trend that is playing out. So it needs to be just understood and I guess a general awareness that transfers are happening later. So there are implications that happen in between that time period that need to be understood, that lend itself to just complexity. So the next point there around changing family structures also creates a layer of complexity because of particularly things like high divorce rates, blended families. So unless you talk about these things, they're discussed at a point when it's a little bit too late and it becomes a bit messy. And another global trend is that so a lot of women are actually set to inherit a large chunk of this wealth. I've got the numbers for this for Australia, but yeah, a lot of that is just attributed to high participations in the workforce and access to higher educational attainment. So how does that sort of translate, I guess, to Australia? There's a lot of similarities. So that magnitude and impact is also set to happen within Australia. So the numbers so far, just to give you some perspective, over the last couple of decades, we've had $1.5 trillion approximately that's been transferred already. And the forecast from the Productivity Commission's report is that is set to increase fourfold, so somewhere close to around $6 trillion by 2050. So that magnitude is set to increase, and the number that set to inherit by women is 3.2 trillion. So it's a large chunk, and so that sort of needs to be understood in addition to some of these other points around which I've already touched on. So housing wealth divide. So there's an interesting stat just around the amount of wealth held by the elder generation in their primary place of residence on average. And this study was done a few years ago, so it would have increased by now. On average, the amount of equity that is held is about 234% more than the younger generation. So, you know, that's a big divide. And the bank of mum and dad has become very important for the younger generation here in Australia in terms of getting access to housing. The fourth point just around retirement and super. So, yeah, the last of the boomers are set to retire by about 2028. And so we know, you know, the boomers drive big trends in the financial services industry. So if they're all, for the most part, retired by 2028, they're all thinking about transferring wealth, inheritance, and estate planning. So, you know, these are interesting trends, I think, that are occurring within Australia. But to me, and a little bit biased, obviously, but it just needs to be talked about either with an advisor or among the family to really allow for a smooth transition. So I've just highlighted the magnitude of wealth transfers. So $1.5 trillion to 2024, the expected increase to 2050. We've just got so the inheritance for women, and then the third point just around improvement for younger generations. So, you know, right now it's very hard, I guess, for younger people to get access to things like property and to even think about starting businesses or anything you might be able to do with a little bit more cash flow available. But that's really what we're talking about, is that financial security. If it's looked after properly, it can allow for not only security, but sort of growth and prospering, which then translates to a better sort of economical outlook as well. So that, you know, there's a lot of repercussions to handling it properly. So I've just got, I think this is an interesting one, because everyone's, it all starts within the families, right? So, so if we look at open communication, so just encouraging, so if you're sharing your needs and your goals with your family, then the more that they understand those, and the more you can sort of go on that journey together. If they're having an impact on what you're doing or helping with what you're doing, then they're more likely to continue doing that and helping you through to where you need to go. So an example I think of I don't do them now, but I used to run Ironman, which is a very long triathlon, can go sort of over 10 hours for some races, and I would never have gotten to the start line, let alone the finish line, if I hadn't had the support. I hadn't vocalized that this was a big goal, and there was training and things I needed to do. Never would have sort of got there if I hadn't had the support from my wife, my family, my little girl. She's very young, but she was there supporting. So the point being, though, you start that open communication. It creates bonds. It allows you to have the conversation, and so that then sort of goes into the next part of it. So that foundation allows you to then go into sort of education and awareness. And you should never start with the numbers and cash flows and investments and savings and all that sort of thing. But the financial planning and the numbers are the lever to allow for some of those goals. So that all starts within the family unit. And then the other part is probably just little things, because really a lot of what we're saying, or a lot of what I'm saying is the conversation, and I keep saying it, is that the conversation needs to be had earlier. So how do you get the younger generation involved? I always think of when I was young, the Dolomites, dare I say it, but they came in, they introduced a whole generation of savers, at least the concept of it, to young people, and it gets you engaged, it gets you interested. But I think in the same way. So if you're speaking to an advisor, get your children involved. If there's any little things you want to be able to do, I've listed those there. So there's this concept of doing it together. You might have, whether that's a trading account or a savings account or whatever it might be, but your advisor might be able to view it, and you can kind of have conversations with the client about what research they've done, or if they're interested in ETFs and things like that. Dollar cost averaging is another great one, particularly in volatile markets, in entrenching that habit and just having the conversation. And then minor account setups, so sort of starting earlier, building that habit, and you're getting a better return than a savings account, for example. So there's different ideas of what to do, but I think the key points are really just in understanding that this is a significant transfer of wealth, and it needs to be talked about now, early on, to get it down and ensure it's all being transferred in the right way. So I think that's it as far as the presentation. But if there's any particular questions that you guys had, I'd be more than happy to answer those.
Dave, that's a really good session and great insight of the whole idea of intergenerational wealth that's happening and will continue to happen. I think we forget that we're part of families, and we have clients, we have friends that might be the recipients of that. I mean, I know in the next 2 or 3 weeks, topically, I've got various clients booked in looking at bringing forward their estate, and about what you said about having open communication, because financials is something that most families don't talk about. But sometimes when the potential person that's looking to do that might have a reason to, maybe health or certain things, and to then try to get the family to have that discussion topically is difficult, whereas if it's done gradually, it's a lot easier. So, and it's 10, 20 years ago we were talking about baby boomers retiring, and they're here now, they're retiring, and they're thinking about a lot of those things that we're talking intergenerationally, providing for grandkids. expensive out there, particularly to buy a place or buy a house. And what I found fascinating with self-wealth, and thanks for your session today, is that it's so cost effective versus your traditional brokerage, online trading brokerage solution. And it's quite easy in terms of looking at what the community, that's the part that I really enjoy the most, is what's the community feeling about the markets? What are they trading in? What are they selling? More so from your sellers or Comsec, and that tends to give you a bit of a broker consensus. And sometimes I think that's a broker consensus. It's not so much what people are feeling and doing. And it's well and truly after the fact as well. So, and I think in terms of around the attendees today and potentially someone that's listening, will see a lot of value in just going in and having a look at it, because and it's definitely not a product push, but it's a viable solution to help grandparents or older people, to help the younger ones manage very much the Dolomite version of what we had growing up, but in a more online, in a more modern way, where those kids are constantly on their smartphones and everything. Any other questions, guys, that you may have for David that might be relevant? Feel free to punch in the Q&A and I can compile them and send them to you. I've got one who's offline, David. One of the questions is, in terms of trading international shares, how easy is it? I think in your slides there you mentioned New York Stock Exchange.
Yep. Yeah. So the first thing that when you're setting up an account with Self-Wealth is that you must have an ASX trading account. It captures a lot of the details from an AML point of view and identification. So that's step one. That the US setup is actually relatively easy compared to that, because we've got a lot of that information. So you actually you jump in online and it's a US wallet. Probably wouldn't even call it so much an account. It's a US wallet. Every international trading account needs a custodian. We use Phillip Capital. So the setup is all digital. It's all online. One part to always factor in, depending on the type of account, is the W8BEN, which is the IRS requirement to set up US trading for any accounts. And so that's a lot easier for individual joint accounts. When it's an entity, a company or an SMSF or a trust, there's a little bit more to it, but overall easier than setting up the initial ASX account.
Yeah, no, that's really good, and that's really insightful there, because I'm fairly sure the recipients of this recording will take advantage of that. Thanks, Dave. Appreciate it. That was a good session. I mean, it's here now upon us, and as advisors across a few here, it's important we help the families, etc., get the right advice and the right guidance. And thanks for that, mate. Really appreciate it. And next speaker, I've got Salvador, who's the head of private wealth with Flint Group. And I've known Sal for a long time, but he has 14 years of expertise in relationship management, primarily in private banking, as well as several years in mortgage brokering. He specializes in supporting high net worth individuals in achieving their financial goals in property and wealth creation. I made the note that Sal's quite down to earth, so he'd probably see most people that not determined by the number of zeros after, but because of that, we can always have a good chat. And about Flint Group, I'll let him introduce yourself. It's about lending. It's about what's topical in the marketplace. Rates are up. People are a little bit poorer than before. They've got less money to go for a steak and chips down the road. And it's about looking at what the lending options are that are available there. Without further ado, I'll hand over to you, Sal.
Thanks, Finlay. Thanks for the intro. Appreciate you giving me the time to speak to some of your clients and partners. Really looking forward to giving some insights in to see how we can help your clients create or build some wealth as well. You just mentioned that clients are poorer, but and I'll get to the fact that property prices went through the roof, so they're actually wealthier. A bit of a weird conundrum that we see ourselves in. I'll see if I can share my screen. Let me know when you can see it. Is that working for you?
Almost there. Here we are. Yep.
Yeah, perfect. Okay.
Mm.
Yeah, so a little bit of Flint. So Flint Group. I'm currently the head of private wealth, but I do look after a range of clients. I cater to the high net worth segment, not just lending, but all stages of wealth creation. The business, as Finlay said, it does specialize in mortgage broking, but we essentially act as financial partners to our clients, offering more than just traditional lending products. So let me just share this. I'll see if I can get this to work. It's a bit of a funny one. Okay, here we go. So we're strategy led. So what I mean by that is that we don't solely focus on just refinancing clients to digital lenders for the lowest rate. We grow wealth with clients based on long-term financial strategy. We look at the future goals, and we actually work alongside a lot of accountants, financial planners. We are usually involved in a lot of their meetings to see how we can structure something in a way to actually build wealth, from debt recycling to building portfolios. Property is a major part of Australian household wealth. David mentioned that there's a big wealth transfer, and property is a major part of that. So our team's won awards. We're very proud of that as well. We've won Broker of the Year for the last couple of years. We're also very tech focused. We look at rates constantly, evaluation reports, servicing platforms for clients. Got offices on the eastern seaboard of Australia, so offices in Sydney, Melbourne, Newcastle, Noosa, and Brisbane. In terms of what we offer, standard residential mortgages ranging from first home buyers, first time investors, clients looking to construct property or ready to downsize. We've seen a huge increase in the value of property in Australia, residential property. In fact, there's been 17 consecutive months of price increases to Australian property, which is just astronomical. As of March this year, the total value of Australian property is at $10.7 trillion, which is up for about 9.8 trillion this time last year. That's $1 trillion in increase in a year. And that's happened while the rates have increased, from 0.1 to 4.3. So that's something that's just counterintuitive almost. And just to put that in perspective, the Australian super fund industry, the market value of SMSFs in Australia is 3.5 trillion. So property represents about just almost three times the value of SMSFs in the market. So property is really the backbone of Australian wealth, and it does complement a lot of portfolios for clients. In terms of the aggregate growth in capital cities, the 5 capital cities in Australia has been about 8% growth year on year. Perth saw about 24% increase in a year. Brisbane and Adelaide both saw 15. Again, just huge numbers out there. And all that while rates have increased. So we've seen clients that are looking to maximize property values, to downsize, use equity from current homes to fund other investments, whether that's shares, managed funds, or buy lifestyle assets. We do a lot of work in the commercial space, from straightforward investment purchases, retail shops, blocks of units, to larger developments. I look after the private banking space. I deal with clients with complex income flows, structures. We also assist in businesses with cash flow lending to expand their businesses as well, and also assist a lot in wealth creation. We have a large lending panel, you can see here. So we major lenders to second-tier lenders to private funders. So we have reach and a solution for a wide range of finance scenarios. What I wanted to chat through here, and Damien did mention this in his slides, is the economy as a whole. So what is the state of play in the Australian economy? And I like to use this as a proxy to where we see the RBA, where they may go next, and how we can get clients to maximize that as well, and take advantage of that. So a lot of data I can go through here. There's some of the key considerations. So we start with GDP. Some concerns here simply based on the data that's been released. It's always lagged. So this is March 24, still relevant. So the RBA focuses mainly on inflation, but if we look at GDP, we can see that it's only growing 0.1% in the last quarter, which is basically nothing. Less than 0.5% for the last year. So really, again, it's very, very stagnant. The main concern here, if you look between the lines, is the GDP per capita. So it's actually going backwards per capita. Now, if you look at what is defined as the recession, is 2 quarters of negative growth. Now, we haven't seen that, it's been flat, but we technically have a per capita recession. And you don't really hear about that in the market, but that's really where we're at. Now, there are a few drivers of that. Weak economic growth, obviously, but obviously the other reason is high population growth, which I'll get to, and that affects the per capita figure there. The other thing is as well, in the March quarter, we saw a Taylor Swift concert and the Formula One both in that quarter, so that should have driven GDP higher than that. So it'd be interesting to see what happens in the next quarter, which is actually released in September. And there is an RBA meeting in September, a few weeks after that. So we'll see where that goes. It could go either way, but what I want to get to as well is the savings ratio. This is quite an important chart as well. As you can see, during COVID, we saw a record of Australians save about 24% of their income. So that's income exceeding expenses, fueled by a lot of uncertainty, but also record low interest rates. So people were able to hold excess funds in offset accounts or savings accounts. Traveling was an option, so big ticket items were curbed, so the expenses were reduced. As the borders opened up, obviously people started traveling, and then second lockdown, people saved again. And then it was May 22 when the RBA started increasing rates, which is 2 years too early. They said they were going to stay flat until 2024. That wasn't the case. So it went all the way down to just under 1% in terms of savings. So it'll be interesting to see what happens in the next 6 months. Property prices have increased, so we might see people tap into equity as well to fund some of that. So time will tell, see what happens. The other thing which is quite relevant is population growth. So very interesting figure here, huge dip obviously during COVID. Border closures led to record low migrations. But when the borders opened, we went the other way and we had record high migration. So in a very, very short period of time. If you look at the chart on the right, the bottom line here is what we call natural population change. So births minus deaths. Around December 2020, interestingly, we saw a spike of births. People spent a lot of time together during COVID. So 9 months later, we saw obviously a lot of births. But what is interesting here is that the main reason for the population growth is migration. So huge migration spike here. Net overseas migration went through the roof. If you look at the headlines in what the government is looking to implement, they put a hold on student visas and migration, so that people will probably go down even further. If the Liberals get into power, Dutton has been pretty adamant on slowing this right down due to a high housing crisis and low stock of property. The proposal is 25% cut to migration levels, and this will bring back this level to pre-pandemic levels, which is fine. But the big change that's on the table is a 2-year ban on foreign investors and temporary residents from purchasing a home in Australia. Now, for perspective, there were almost about 1,500 approvals by the Foreign Investment Review Board to foreign buyers last financial year. This would free up about 100,000 homes in the next 5 years, according to government data. The problem with that is, it's great for stock levels, but also it might drag down further growth in the economy. So it's a bit of a double-edged sword there. But time will tell as well. This is the key graph really that the RBA looks at, and that's inflation data. So Michelle Bullock has made it very clear that inflation is public enemy number one, needs to be reduced, even if that means another rate increase. So there might be some pain to the economy if that does happen, to businesses and households. But it's very clear that they want to bring this down very quickly. If you look at the monthly inflation data, it's coming down here. It's sub 4%, so it's going in the right direction. It's still above the band of 2 or 3%. But the RBA won't look at monthly data. They'll look at the quarterly inflation data, which is this circle here. It's been bouncing, so it hasn't reduced constantly. It's gone down, the increased again, down, increased. So the next quarterly inflation print happens in the 31st of July. Now, I believe if that print is over 1%, a rate hike is almost inevitable. At the moment, there's about 50-50 chance of that happening. Early in the year, there were, most economists were pricing in 2 rate cuts, but now we're going the other way, maybe another rate hike. So it'll be interesting to see what happens at the August meeting. That's a few days after the RBA at the inflation data is printed. So that is really key to see what happens next. Now, the government don't really want rates to be increased for various reasons. Number one, they want to show that they're on top of the cost of living crisis. So, leading into election, they also want to avoid a recession. So that's important for them to maintain. If there is a rate increase, Australia will be the only G10 country that will increase rates while others have started cutting rates. Now, that's not a good look for the Australian economy either. Now, 25 points, might not hurt the back pocket as much, but it does a lot of detriment to consumer confidence and business confidence. Jobs will be cut more, slowing growth, recession looms. So the government may not be able to say they've avoided a recession, which is what they want to say leading into an election. But in saying that, the RBA does need to be independent to what the government thinks. They need to not be influenced by the government. And again, time will tell. So we'll see what happens there. It's very interesting times. So we'll see where that leads. Now, lending niches, I'll try and be quick with these. So we've helped a lot of clients with different things, and a lot of clients don't know what they don't know. So we like to showcase what we can do and what we showed for clients. So number one, you can get funding without personal income, potentially. Now, when I say this, it's in relation to commercial property, so lending based on simply using the leases. The lender will match the loan term to the weighted average lease expiry. So the lease income covers the interest with a buffer. There's no need to supply full financials. It's good for certain clients which cannot show, potential personal income. We're working with a client now who's retired. She wanted to further diversify her assets, so she needs some money to fund an investment to a non-liquid managed fund. She had a commercial asset in Queensland. It had an IGA, a bakery, and a hairdresser. So it's a commercial asset with a few tenants, all had leases for a couple of years. Now, what we did is we refinanced the debt from about 8% to just under 7%, so 1% cheaper rates. She didn't have any personal income, just the leases. So she received an additional $500,000 to fund another investment. The lease covered about 65% of the property value. So we were able to fund that without looking under the hood for any other income. So we've got a lot of high net worth clients that don't have a lot of income, but have a lot of equity. They might have a lot of assets and a lot of rental income, which will be able to cover the interest rates. So we've seen a lot of that happen in the last couple of years, and it's been able to pay for itself. The other one is SMSF lending. Now, these have really changed in the last 5 years or so. Major lenders have grandfathered loans, so they don't actually offer SMSF lending anymore. It's too risky. There's a lot of compliance. they stepped away completely. Now that's opened the doors to a lot of second-tier lenders to come on board. The rates are really competitive. They're no longer in the 8 to 9%. They're very close to standard residential rates. And the best part of SMSF lending is that it's usually isolated to the SMSF. So lenders won't look at any debt that clients have personally. They'll just look at what the SMSF has. They'll look at the contributions the client has, the rental income and investment income to service the debt. So we had a client recently paying over 9% on the SMSF because they've just left it with a major lender. They didn't decrease rates as the rates went down in the last couple of years. So we were able to refinance that quite easily, just based on the fact that they were able to pay lower rates going forward. So that's a good way to increase borrowing through SMSF lending. Another way you can do it is borrowing through a trust. So, lenders at the moment, they're able to isolate trust lending as well. So we have clients that borrow one property in one trust and then borrow the next one in the next trust. What happens there is lenders are able to exclude lending in the other trust because it's self-sufficient. So usually what we need for that is an accountant that say that it's a profitable trust, and they won't look at the debts in that trust. So that's able to build portfolios quite quickly. We're working with a client at the moment that's based in Hong Kong with his wife. They have 2 young children. They work for a listed business. They borrowed fund within trust for investments over several years. They built a portfolio, and the plan is to borrow for a personal residence when they repatriate back to Australia. And that way they're able to boost the borrowing capacity because the lender won't look at the borrowing of the trust. So we're able to build wealth in that way. We're able to look at things that traditionally lenders won't be able to do. If they go direct to a lender, we're able to actually facilitate that for clients. And finally, we actually have, we're working with a lot of private banks and access to high net worth policies, such as the ability to leverage off listed stocks. Perhaps these are vested. We can use these towards income to service. We have the ability to access policies where clients can obtain 95% borrowing without the need for lender's mortgage insurance. So high LVRs for high assets, especially now that property values have increased, and able to actually facilitate lending for those clients. So I've said a lot there. So thanks for the time, Finlay. Look, there's a lot more we can cover, but I tried to rush through that because we're running out of time. But thanks for allowing me to share some things.
You've done terrifically well, Sal, considering you were the last speaker and you were under the gun. But really good session, and I love this slide, particularly the lending niches. And I think what's topical is the whole story, the Australian story of bricks and mortars being the driver of their success and wealth creation over the last 30 years. And with lots of borrowing has meant that they've gone to looking at the possibilities in self-managed super funds. So it's interesting to hear from your perspective. As you said, banks have come out. There's been some emerging second-tier lenders, and are they viable? Are they good to deal with? They're not going to disappear overnight. And as you said, that's probably the question there.
Yeah, no, well, look, they've been around for some time, and the digital banks have been swallowed up by bigger banks, but the second tiers have they got a lot of market share. So we've seen them increase while a lot of lenders have pulled out. So particularly if you look at development funding, a lot of major banks have just lowered their risk appetite on that, similar to SMSF lending. So that's just allowed other players to come on board. They haven't just come out of the woodwork and funded by a certain person, but they actually well backed by investors, so high net worth clients, actual super funds, industry super funds back a lot of these as well. So I think our market share will increase as well, particularly as banks tighten up post Royal Commission. So and good to deal with as well. They're not slow. They used to be, but they've really turned around. Yeah.
That's terrific. And we've got a question from Chris who's here. for you, Sal, is moving property from personal ownership into a joint family trust a straightforward process, and can they be moved into SMSF trust?
Okay, so if you own a property in your personal name and you want to move it to a trust, the process isn't difficult, but you have to take into account the two things: capital gains, because you're essentially selling it to a different entity, even though you might be the beneficiary of a trust. You're selling that to an entity, so that has capital gains implications, but also potential stamp duty implications. So if you're buying it through a trust, you might also have to pay stamp duty again. So that's probably more of a question for your accountant, and making sure they structure in a way where that is minimized. But it is a hard one. It is a costly one. Same with the SMSF. So the SMSF would have to buy it off you personally. Capital gains and stamp duty implications will also apply. With SMSF, there are tax benefits in that regard, but you still have to pay some sort of stamp duty or capital gains. So I would say, let's look at the next one in a trust or the next one in this SMSF. That's probably the most cost-effective way of doing it.
Yeah. No, that's a good way of great answers there.
Just to add to that, can you sell it to yourself at a devalued price to minimize the cost there?
No, you unless you gift it, no, you have to get a market valuation on it, and you can't sell it at $1, for example. It's there. You're going to get caught by the tax office by doing that.
Right.
Yeah. That's great. And thanks, Sal. With interest of time, guys, to sum up the key takeouts from the great speakers today, with a bearish outlook on markets, all things shares, review your existing portfolios, whether it's inside or outside of super. Families to have open communication for future estate planning, and part of that intergenerational wealth transfer being made easier. And in terms of reviewing your lending scenario and looking at alternative solutions, there are competitors in the marketplace other than your traditional bank lenders that will provide you various options, whether it's personal lending, residential lending, in or outside of trust structure. With the benefit of time, and thank you to the speakers. Thanks, guys, for attending. Any other questions that you have, Chris, Sean, and everyone else that attended, those that are listening to this recording, feel free to circulate it to myself, and I'll circulate it to Sal, David, and the team at Zenith there as well. Have a great afternoon, everyone. Take care.
Thanks, Finley.
See you guys.
Bye.